Hello and welcome to Macros with Mythili, where we take a hard look at all the major macroeconomic developments before the country. Well, the one major development on the macro scene that's going to be playing out over the next few months, if not years, is FM Arun Jaitley's budget. In particular, the measures he's announced for the infrastructure sector. And that's what we're going to discuss in this edition of Macros with Mythili. Will the budget be a game changer for the infrastructure sector? And joining me in the discussion are experts with hands-on experience of the infra sector, Mr. A.K. Upadhyay, former Secretary Road Transport and Highways and also Secretary NHAI, and Santosh Nair, Chairman IIFCL, India Infrastructure Finance Company Limited, and of course T.T. Ram Mohan, Professor IIM Ahmedabad, a keen observer of the Indian economy who specializes on the Indian financial sector. Let me start with you, Mr. Upadhyay. You've been there, seen it, done it all. Tell me, will this really, all the measures that the FM has announced for the infrastructure sector, 37,800 crores for national highways, REITs, investment trust structures, tax concessions for them, tax concessions for power sector, 16 new ports, a whole host of incentives is announced. Will all this, any of all this or all of this, will it really change the scene as far as infrastructure is concerned?
Oh, definitely. If there is one sector which gets a definite push in the budget, it is the infrastructure sector. Now, if I come to highways construction, the major problems faced by highway sector was basically three. You can divide into three parts. One was, with which everyone is aware, was the government's internal process of approval. You know, the whole process of planning commissions vetting, then economic affairs, then final approval by the competent authority, clearances from environment and forest. So those processes were a bottleneck, were a major problem. Second group was at the operational level, giving the clear right of way, you know, removing the utilities, trees, land acquisition. And third major problem was the financial constraints. You know, the total debt market here is very limited. Most of the debt financing of the road project was by the banks. Now, commercial banks have sectoral limits. So this was severely constrained. So therefore, in the budget, the announcement of incentives for infrastructure investment trust is going to give a big boost. It is going to create a long-term debt fund for financing infrastructure.
Santosh, Mr. Upadhyay mentioned three major stumbling blocks: land acquisition, environmental clearance and financing. Now, you've been in the area of finance for such a long time, first with the State Bank of India and now with IIFCL. How difficult was it and how perhaps unwise was it for banks to really go into infrastructure? And is there really a need for development financial institutions like yours to really kind of give a push to infrastructure financing? And will this budget make a difference really as far as bank financing is concerned, given that the FM has assured their banks that things like SLR, CRR, etc. will not apply to money that they raise if they use it for infrastructure finance?
Yeah, I would like to respond first to what Mr. Upadhyay said. Actually, from my experience in road sector, financing was not as much a constraint as it was, say, in power sector. Financing for road sector actually slowed down considerably when, you know, project after project getting into restructuring more because land was not being given or could not be acquired, or because environmental clearance was not coming or forest clearance was pending. And this led to substantial amount of project developers coming and asking for restructuring. Before there was a fall in the traffic, there were a few cases where the traffic was not as estimated. And those projects actually are coming up now, you know, in the last 1 year or so. But before that itself, 2 years back, this problem of road sector, you know, regarding land and forest clearance started, and that is what, you know, pulled the banks back. But now some of the other sectors, if you look at infrastructure sector, definitely sectoral caps are coming into problem, particularly power sector where the expansion is large. You must understand that close to 58% of the infrastructure lending by the banks were towards power sector. Now, some of the measures which this budget has proposed definitely will help. You know, one of the measures which I have been advocating when I was in SBI and I have been taking it with RBI, and which now subsequently it was, I think it's come in the budget now, is the financing of project over asset life. You know, what has happened was, whether it is road project or a power sector project, the banks had continued project financing the way they did SME financing or regular term financing. Look, they said that, okay, our deposit profile is about 5 years. So we cannot lend more than 10 years. Now, this was the policy with which all of us grew up in the bank with. But you know, when you look at project financing and as the project becomes bigger, the project implementation itself takes about 3 to 4 years, and then asking those bank developers to pay back in 6 or 7 or 8 years it becomes very difficult. The debt service coverage ratio is made very tight, and 1% drop in the GDP or a traffic or tariff, the developers would come and say we need restructuring. Whereas in developed markets, how it is done is this is spread over the asset life. That is, if the concession is for 25 years, they get a loan about 22 years, or the concession is 30 years, they get for 30 years, 25 years. And while the developer keeps paying over a period and his repayment becomes half, the loan itself is given every 3 or 4 or 5 years, and it refinances every 4 or 5 years. So the developer's repayment obligations become half. So the restructuring goes down, the cash accrual with the developer increases, the tariffs goes down. So the economy benefits, the developers benefit, the lenders benefit. I think this has now come through in the budget. This will substantially change infrastructure projects the way it is planned in the country. And actually, my suggestion to RBI was that not only for infrastructure, it should be made applicable to all major projects, including say cement and steel and all that. Because if it's prima facie acceptable, I think this will enable a lot of projects to come up.
Let me toss that question over to TTR. TTR, one of the biggest problems really with bank financing of infrastructure was the inherent asset liability mismatch, because banks raise deposits usually for a maximum of say 5 years. Typically infrastructure projects go on to 20-25 years. So now the FM has suggested what he talks about as a 5x25 structure, whereby banks can give a loan for 25 years and after 5 years transfer it to some other bank. But isn't this very similar to what was called as takeout financing? And if that did not work, why will 5x25 fare any better?
Yeah, you see, I mean, there's no point in trying to fix this problem by focusing on the financing side. I mean, the main failings have been on the institutional side. I mean, some of the things the earlier panelists talked about, which is, the delays in land acquisition and environmental clearance and the lack of fuel supply. So, I mean, these require major institutional issues to be addressed, and then, the infrastructure projects will get going. But that apart, even before you begin to address the issue of financing, you have to understand that the PPP model itself is broken in many ways. I mean, if you look at the components of the model, which is the terms of the concession, the bidding parameters, the dispute resolution mechanism, all these things need to be fixed first, and then, the finance will start flowing in, because how do you expect lenders to have confidence when basic issues relating to the PPP model and the institutional failures have not been addressed? Now, so far as the specifics of bank financing are concerned, well, it's all very well to say that you will have a 25-year arrangement, and every 5 years you'll have a takeout. But for these things to work on the ground, you need a lot of other elements in the banking sector itself to be fixed. Now, for instance, they're trying to incentivize this kind of infrastructure lending through forbearance in respect of statutory norms, CRR, SLR ratio, priority sector lending, and so on. And the idea is that if you soften the rates somewhat and improve the returns to these projects, then the finance there'll be both the demand and supply of finance will increase. But I think, as you rightly pointed out, the fundamental issue here is the asset liability mismatches. And if you really wanted to improve the terms of lending, then perhaps a better proposition would have been to simply issue tax-free bonds, to allow banks to issue tax-free bonds. That would have been a better proposition. Instead of trying to relax CRR and SLR norms, which have a bearing on risk management and risk mitigation. So I think this is not quite the right approach to take when it comes to addressing the issues of financing of infrastructure sector. Then again, the issue of bank recapitalization. I mean, how do you expect banks to have capital for, an appetite for enhanced infrastructure lending, unless they are sufficiently confident on the capital front? And it's not all clear that the 11,000 crores which they have allocated for recapitalization is an adequate level of capitalization for banks. So you're really, in many ways, in every way, you're putting the cart before the horse.
So we're putting the cart before the horse. We look at financing before we address the fundamental issues. But at this point, we'll have to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing whether Budget 14-15 could be a game changer for the infrastructure sector. Mr. Upadhyay, you're very hopeful that the measures announced in the budget will be the game changer. But let me quote to you some numbers from the economic survey. And it says, the economic survey says that out of 239 central infrastructure projects of more than rupees 1,000 crore, as many as 110 are delayed, and the cost overrun is as much as 1,57,802 crores. Now, given this kind of a situation, what can really change as far as things in the infrastructure sector are concerned?
I think one thing is that at what level you award the project. Perhaps earlier, because of the pressure of awarding projects, even before the projects were ripe for awarding in terms of land acquisition, in terms of clearances, we were awarding that, hoping that simultaneously they will happen. It didn't happen in practice. The environment clearance didn't come in time, the land acquisition did not take place in time, and hopefully we were very ambitious and optimistic that all those things will come in place. Now government has taken a very wise decision that we would be awarding projects only after a minimum threshold of at least say 80% or 90% of land is there in hand. So therefore, I guess with that kind of discipline, this problem will be minimized. And secondly, the problem of environment and forest earlier, with the messages we are getting from the new government, I think that will be minimized, because lot of objections, lot of delays were not on any substantive issues. They were delays just for the sake of delays. So I believe if there is a commitment that the things have to be done, I think those delays will be minimized. And the very fact that this PM had a meeting with the secretaries, that was his first official engagement, that sends the message that yes, there is some forum where the problems will be resolved. Earlier, if there were 2 or 3 ministries fighting with each other, there was no forum which could take a final decision. Now with the new government's clear message, there is some institution, some forum where things will get resolved. So I believe that problem is a thing of the past. With the decision to award projects at a greater level of ripeness, and with the clear message that delays will not be tolerated, or there is some institutional mechanism to solve it, I believe that is a matter of past.
Santosh, are you sufficiently enthused with that assurance from the government? Do you think delays, cost overruns are things of the past, or you think that's part of the entire system and banks and financial institutions just have to live with it? And is an institution like IIFCL better equipped to handle these things than a commercial bank?
Mythili, before that, I would like to clarify on an earlier point which was raised, that is regarding this proposed, what is called 5 by 25. Basically, what happens is here, this infrastructure bond, and where the CRR SLR bond exemption is being sought, that is completely different from the 5 by 25 scheme. These are 2 entirely different things. The 5 by 25 scheme, or exactly what we are saying, is like it happens in all the developed markets, where I have financed many projects for Indian assets infrastructure acquisition abroad, where all the overseas banks, what they do is they don't ask the developer to pay back in 5 years or 10 years as we do here. They allow, like even if you take a home mortgage in say UK or US, the repayment obligation is over 25-30 years, but the loan given to you is for 3 or 4 years. At the end of the 3 or 4 years, you have the option to refinance by the same bank or by different banks. So here the amortization is done over a long period, but the loan itself is given as a 5 year period. So in the bank's asset liability book, it is shown as a 5-year loan, not as a 30-year loan. So this is just a correction of the existing practice. There is no additional funding being given. For example, when the banks give cash credit now, it is given for 1 year, it is shown as a 1 year loan in the bank's book, but it can continue for 30-40 years, and there is no asset liability mismatch. What we are trying to do is to bring the same principle into term lending, so that the repayment go down. Now the banks issuing infrastructure bonds is a different matter, because banks, unless what the developers are asking is like it happens abroad, since we don't have a mechanism outside the banks, all the infrastructure projects need fixed rate long term funding, and that can come only when the retail bond, money comes into the fixed rate bond market. And this is a way of kickstarting the bond market by banks actually trying to pull in the retail bond market, money into the bond market, and they can on lend at a reasonable cost only if SLR CRR exemption is given. So this is a different thing. Now coming to the clearances, I truly believe that this government is very serious about clearing all those bottlenecks, etc., etc. Probably action will come, and I think country and all of us realize that what has gone wrong and what needs to be done. Because if we have to improve as a manufacturing power, we need to improve our infrastructure. There is no question about that. My issue is not the clearances, which will definitely come. My issue is that even if assuming that all the clearances are in place, you need to find money to finance these infrastructure projects. And now in our country, the only option is banks. And banks will very soon reach they have already reached, and sometimes other sectors, they will very soon reach the sectoral caps. Because banks are not very well capitalized. Banks are relatively international standards, small banks, except State Bank, for example, all the banks are quite small, and they will find it very difficult to take additional exposure. So if you are talking about $1 trillion exposure in investment in infrastructure in the next 5 years, we need to find where the money is going to come from. And overseas money simply cannot come, because if you look at the history of all other developed countries, I don't think any other country has developed purely through overseas money. And in our case, the long-term money cannot come in because we don't have the hedging. And once you hedge, it actually becomes much more costly than the local rupee funds. So possibly we need to have institutions outside the Basel III, outside the banking system. We need to develop who can raise capital and then leverage it substantially high. Like for example, China Development Bank has done, which is leverages capital 30, 40 times to benefit the Chinese economy. We need to look at bringing back those kind of institutions. DFI was there earlier, but maybe or some other form, we need to bring them back.
Okay. So let me ask TTR that question. DFI is in another form, or can the corporate bond market provide the necessary finances? The finance minister has talked about infrastructure investment trusts. Are these alternative models where banks cannot meet the requirements, and yet we have a huge need for financing of these infrastructure projects?
Well, I think the basic approach is what I would question. What the finance minister is trying to do is to improve the returns at the margin through all kinds of special provisions and dispensations. I mean, the infrastructure investment trust, which will have a pass-through facility so that the interest income is not taxed, regulatory forbearance in respect of bank lending, and then tax holiday for power companies and so on. So you're trying to improve the returns at the margin, but I would submit that the problem is not the absolute level of returns in infrastructure. The problem is the variability of returns and the risk associated with infrastructure projects for all the reasons that we have been mentioning so far. So unless and until you address the high level of risk associated with infrastructure projects, you're not going to see any kind of major finance coming into the sector. And I think it makes more sense, for instance, to boost the capital at the banks in a big way so that they have that much more confidence to lend instead of trying to improve the returns for investors. That is probably a more sensible thing to do. And the other thing you need to understand is that the potential borrowers in the sector, the leading infrastructure companies, are up to the neck in debt. So you need to go in for debt restructuring at all these companies, which is going to be a very long drawn out process. Some of them will have to monetize assets which are monetizable, and this process has been underway for the past 1 year. So there are a number of issues at the ground which have to be fixed. And just trying to improve returns at the margin is not going to help.
Absolutely. But at the end of the day, returns are important, and we'll address that after taking a very short break, because that's where the private sector comes in, because it's looking at risks as well as rewards. But on that note, we'll slip into a very short break, but please do stay with us. Welcome back. You're watching Macros with Mythili, and we're trying to decide whether the budget is going to be a game changer for the infrastructure sector. Before the break, both TTR and Santosh talked about the need for a return and how money will come in only if there's a return, which brings us to the entire issue of PPPs, public-private partnerships. Now, the finance minister seemed to give a great deal of emphasis on PPPs, but that's something that we've had in India for so long, and it just doesn't seem to have worked. What really was the problem, Mr. Upadhyay? Why is it that PPPs haven't worked? And should we hope any more from this 3P India initiative? Will it change things? Can we get the private sector to bite?
Mythili, I have a slightly different view from yours. To say that it didn't work is not entirely correct, because as far as highways is concerned, we were awarding the largest PPP program in the world in highway sector, and our whole model was taken as one of the good models, where there was a stability of contracts, and across the board all over the country, same format, same model contract documents were implemented. So therefore, and we had toll rates completely locked in at the time of contract. At the stage of implementation, 2 or 3 things happened. What happened was that when the things were going good, the banks were also probably a little lax in due diligence, and they financed projects left, right and center. And most importantly, some of the good projects where they were very aggressive bidding, and right away it was very clear that the bids were, in terms of premium offered, probably were not viable. So therefore, these problems combined created a situation, and then the economic downturn, global economic downturn in the 2009-10 later, that created a problem, and the pendulum swung on the other side. Now banks became very, very conservative. From a very liberal approach, they became completely tight-fisted. So I don't think this is a fair assessment. We had a proven regime of PPP, at least in highway sector, and I believe that it would work. If you remember, FM has also mentioned that there is a need for flexibility in contracts. because it is a dynamic situation for 20, 30 years of concession period. It may not be feasible to have one rigid contract for the entire duration. It may need renegotiation, reworking out. That is very cumbersome right now, and so therefore that may need tweaking, little tweaking.
Santosh, can PPPs really be the way forward? The private sector is going to come into the 3P initiative or the public-private partnership only if they can get a return. And as long as there's politicization of tariffs in the case of power sector, tolls in the case of the road sector, when you don't have independent regulators, there's always the issue of why will the private sector come in and where does it leave financing institutions like yours?
No, I think we have learned from the experience of the power sector now that there must be a pass-through. For example, the new revised PPA which they are signing, wherever there is a import quality components, they are emphasizing that it should be pass-through. I think the realization is coming in any product unless somebody pays for it, the product is about to fail. So I don't think the lenders will be enthused to lend when if the pass-through is not there or the tariff, somebody is willing to pay for the tariff. If there is a tariffs regulated, probably they will look at budgetary support and see how it becomes overall viable. Now, the particular model which I had advocated and which has now come in the budget is when the asset life based financing. When you are asking a developer to pay back in 25 years instead of 12 years, automatically tariffs also come down. For a lender, they don't look at it whether it's a PSU or a PPP. You need to have some kind of assurance about the cash flow. And that is very important.
Investor needs to have some certainty about the cash flows. But is it really fair to allow the developer to have complete pass-through, or should that be considered part of the business risk? Mr. Upadhyay talked about flexibility, but is there any sanctity of a contract if you allow flexibility, and how often should flexibility be allowed? Does that leave scope for corruption and all the other ills that already plague the Indian economy?
Well, yes, I mean these are valid points, and the flexibility which people are talking about is flexibility given to the private party, but I think equally the government needs to have the flexibility to rebid if the contractor happens to underperform or not meet some targets. So you see, this whole the way the contracts are written, we need to apply our minds a lot more and rework some of these contracts. Yes, I think there's a very interesting statistic in the finance minister's speech. He says that India has the highest number of public-private partnerships in the world, at the moment 900. And this is the highest figure for any country in the world. And you have to wonder why the rest of the world has let India hog all the glory in this respect. And could it be that they're rather more skeptical about the PPP model than we are? And in the developed world, as you know, and also in China, wherever infrastructure development has happened in a big way, it is always the state which has been the leading player. And now we are somehow hoping that we can do things very differently, and I agree that the private sector has a considerable role to play, but whether it is wise to rely on state investment only to the extent of about 15% or so as projected in the budget, and to leave everything else to the private sector, I think it's too much of a too much of a risk to take. And so it's not going to be the game changer. It's not going to be the game changer you said it might be.
Well, I'm afraid that's all the time we have to discuss in this edition of Macros with Mythili. As you can see, TTR remains very skeptical about PPPs, so the jury is still out. Our discussants are not unanimous on that. But on that note, I'm afraid we have to put an end to this discussion. Thank you so much, Mr. Upadhyay, TTR, as well as Santosh, for joining us in this discussion. Thank you also for watching, but we'll be back next week, same time, with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.